Imagine walking into a boardroom, looking your most important investors dead in the eye and telling them that your grand master plan for the upcoming holiday season is to intentionally starve your best retail partners of inventory.
Right, yeah.
You're just purposefully going to hold back shipments, watch your quarterly sales figures completely plummet by double digits, and, effectively force your own company to take a massive financial punch to the gut.
Yeah.
Okay, let's unpack this because it sounds like absolute corporate sabotage, doesn't it?
Oh, it sounds exactly like a CEO writing their own resignation letter, honestly. I mean, in almost any other context, telling a massive grocery chain that you refuse to restock their shelves, well, that's the fastest way to destroy your brand's footprint forever.
Right. But that is exactly what is happening right now in the consumer packaged goods sector. So welcome to this Talk Tickers Deep Dives. Today, our mission is to slice straight through the pretty dense corporate jargon of the Simply Good Foods Q3 2026 earnings call.
Yeah, the one that just happened on July 9th.
Exactly. We are looking at ticker symbol, SMPL. And if you hold this stock, or maybe you're eyeing a potential value play, or honestly, if you just want a masterclass in how a consumer brand fights for survival during an inflation crisis, you need to understand the mechanics of what management is doing here.
For sure, because it's wild.
It really is. We're going to determine if this aggressive, seemingly backward strategy is the ultimate turnaround masterstroke, or if it's, just the final gasp of a dying portfolio.
And that portfolio is likely sitting in your pantry right now. I mean, Simply Good Foods is the holding company behind massive consumer brands like Quest Nutrition, Atkins, and OWYN.
Which stands for only what you need, right?
Right, yeah, exactly. They absolutely dominate the purposeful nutrition aisle. We're talking about protein bars, ready-to-drink shakes, low-carb chips, keto-friendly cookies.
The stuff everybody buys when they start a diet in January.
Exactly. And for years, these brands basically printed money. But this recent Q3 call, it really pulled back the curtain on a company that is currently enduring a brutal, painful restructuring process.
It's intense. And the stakes here, they really couldn't be higher because you have a consumer base that is completely exhausted by grocery store inflation, right?
Totally tapped out.
And you have supply chain costs that are just refusing to normalize. And in the middle of this massive macroeconomic storm, Simply Good Foods is announcing a high single-digit price increase across their entire portfolio.
Starting in September, yeah.
Right, in September.
Yeah.
So we need to figure out if jacking up the price of a protein bar by nearly 10% is going to actually save their profit margins, or if it'll just, drive their last remaining loyal customers straight in the arms of cheaper private label store brands.
It is a phenomenal gamble. I mean, Joe Scalzo, the CEO, and Chris Bueller, the CFO, they are attempting to execute a textbook margin recovery here.
Yeah.
But to understand why they're resorting to such aggressive tactics, you really have to look at the severe damage reflected in their latest financial print. The quarter ended May 30th, 2026, and the raw data, it presents a fascinating psychological study in how Wall Street prices in disaster.
Well, let's put that hard data on the table for everyone. Because for Q3, net sales hit $357 million.
Right.
That is a 6.3% decline compared to the exact same quarter last year. And when you look at their adjusted EBITDA, which gives us a clean look at their core operational profitability by stripping out the taxes and interest.
Yeah, the real money they're making from operations.
Exactly. That came in at $57.2 million, which is a devastating 22.5% drop year over year.
It's brutal.
Almost a quarter of their core profits simply vanished. Just poof, gone.
And the metric that keeps consumer packaged goods executives awake at night, the gross margin, it took a severe beating. Gross margins contracted by 390 basis points, settling at 32.5%.
Okay, let's translate that for anyone who doesn't spend their day staring at bond yields. A basis point is simply 1/100th of a percentage point.
Right.
So when you hear 390 basis points, it means their gross profit margin shrank by almost 4 full percentage points.
Which is huge.
Massive. In a high volume, low margin business like selling snacks, losing 4 percentage points of margin is like, trying to run a marathon while slowly bleeding from your leg.
That's a great way to put it.
It is a massive squeeze on the cash they generate after paying for the direct costs of manufacturing.
Yeah, but the number that caused the most initial shockwaves was the GAAP operating loss. Under generally accepted accounting principles, Simply Good Foods reported a loss of $49.9 million for the quarter.
Wait, let me challenge the narrative here for a second. You have a company selling millions of protein bars every single month, and they are reporting a $50 million loss.
On paper, yes.
That instantly screams systemic failure to me.
Yeah.
But management completely brushed past this on the call, like as if it wasn't a real loss. Why?
Because in terms of actual cash leaving the building, it wasn't a real loss.
Okay.
That $49.9 million operating deficit was overwhelmingly driven by an $82 million non-cash impairment charge.
There's that term.
Right. And this specific charge was tied to the intangible assets and goodwill associated with the Atkins and OYN brands.
Okay, let's dig into the mechanics of that. Because non-cash impairment charge is the ultimate Wall Street smokescreen, right?
Oh, absolutely.
I want to build an analogy here. Let's say you buy a duplex as a rental property. You pay a premium, say $1 million, because it's in a great neighborhood, the current tenants are paying high rent, and you expect that cash flow to continue for decades.
Makes sense.
So you put that $1 million asset on your personal balance sheet. But 3 years later, a toxic waste dump opens across the street. The neighborhood decays. Your tenants move out. You can only charge half the rent you used to.
Right. Your asset is impaired.
Exactly. You haven't written a check to anyone. You haven't lost cash from your bank account today. But if an auditor looks at your books, they're going to force you to admit that your property is no longer worth $1 million.
You have to write it down.
You have to write down the value of the asset. Is that essentially what Simply Good Foods just did?
That is a perfect translation of corporate goodwill impairment, yeah. When Simply Good Foods acquired OMAY, and when they originally assessed the value of Atkins, they assigned massive monetary value to the abstract concepts of brand loyalty, trademark recognition, and future shelf space dominance.
That's the goodwill.
That is the goodwill. And every year, auditors run complex discounted cash flow models to see if the brand is still generating the revenue that justifies that premium valuation.
And clearly it wasn't.
Not even close. This quarter, management had to formally admit to Wall Street that the Atkins and OMI brands have lost massive cultural relevance and momentum. They had to take an $82 million eraser to their balance sheet to reflect the new, pretty depressing reality.
So we have sales down over 6%, operational profit down over 22%, margins crushed by almost 4%. And management openly admitted they destroyed $82 million in brand value.
Yes, the summary.
By any logical measure, this is an absolute disaster. Yet the stock didn't completely collapse on this news. In fact, management framed this quarter as a weird sort of victory because they, quote, beat internal expectations.
Right.
How is losing less money than you thought you would a victory? Like, why would institutional investors look at a shrinking business and nod approvingly?
Well, what's fascinating here is the mechanics of market psychology. Wall Street functions as a forward-looking discounting mechanism. They hate uncertainty far more than they hate bad news.
Okay, that's a key distinction.
Right. So going into this earnings call, management had already sounded the alarm bells. They warned analysts that the turnaround was going to be excruciating. Institutional models were bracing for a total freefall in sales and margins.
So the bar was on the floor.
Exactly. The fact that sales only declined by 6.3% meant the floor held. It's the difference between a pilot executing a very rough, sparking emergency landing versus the plane nosediving into the side of a mountain.
So the market had priced in a mountain collision, and they were just relieved to get severe whiplash.
Exactly. But to determine if this plane can take off again, we really have to look at the structural damage. We have to examine the why behind that 390 basis point margin compression.
Because it wasn't just poor execution.
No, not entirely. It was not just poor sales execution. Chris Bueller explicitly detailed that they are being battered by severe macroeconomic inflation, primarily within the protein complex.
Let's dive deep into that supply chain because honestly, it dictates the survival of this entire company. When your entire brand identity is built around selling high protein snacks, inflation in dairy and plant proteins is a direct, unavoidable tax on your existence.
Right. You can't avoid it.
You can't just reformulate a Quest bar to have less protein, right? It completely destroys the core value proposition.
Precisely. And let's look at how protein commodity markets actually function. Take whey protein isolate, which is the foundational ingredient for a massive chunk of their portfolio.
What exactly is whey for the listener who just eats the bar and doesn't read the label?
So whey is a byproduct of cheese manufacturing. The liquid left over when milk is curdled is heavily filtered, dried, and turned into the powder that goes into these bars. And the price of whey is deeply tethered to global dairy yields, cattle feed prices, and even weather patterns affecting pasture quality. Over the last 2 years, global dairy constraints have kept these input costs incredibly elevated.
Wow. And it isn't just the dairy side, is it?
Nope.
Because the plant-based protein market, which supplies the Oberon brand with pea and pumpkin seed proteins, has faced its own agricultural supply shocks and processing bottlenecks.
Yeah, it's hitting them from all sides.
But Buehler didn't just blame the ingredients on the call, did he?
No, he pointed to a trifecta of inflation. It's the proteins, it's the packaging, and it's the freight.
Let's break those down.
Sure. Think about the physical wrapper on a protein bar. That requires specialized, multi-layered resin and foil packaging to ensure a long shelf life and prevent moisture from ruining the product. The cost of those petroleum-based resins has spiked.
Right, because of oil prices.
Exactly. Then you have to put those boxes on a pallet and hire a freight carrier to drive them across the country. Diesel prices, driver shortages, warehouse labor costs, they've all permanently shifted the baseline cost of doing business upward.
So when it costs substantially more to source the raw whey, significantly more to buy the plastic wrapper to protect it, and exponentially more to put it on an 18-wheeler, your gross margins are systematically dismantled unless you can pass those costs onto the consumer.
And this margin degradation, it also included a self-inflicted but necessary wound. Embedded in that 390 basis point drop was $6.2 million in one-time restructuring costs.
Meaning they are spending precious cash right now to fire people, break leases, or consolidate manufacturing facilities.
Yeah.
They are basically paying for the privilege of becoming a leaner company.
Yeah.
In fact, if you strip out that $6.2 million restructuring charge, Buehler noted their gross margin would have been 34.3%.
Right.
That is a 210 basis point decline instead of 390. Still terrible, but I guess it shows that underneath the noise, their internal cost-cutting initiatives are acting as a tiny parachute.
Which brings us to the actual products. You cannot look at Simply Good Foods as a single, uniform entity. It is an amalgamation of distinct consumer brands operating in very different microenvironments.
Right.
So to understand if this turnaround is viable, we have to break down their portfolio into the good, the bad, and the ugly.
Well, let's start with the good, because they desperately need a growth engine right now. Quest is their crown jewel. It is the largest brand in their stable.
Oh yeah, by far.
For Q3, Quest managed to grow its overall net sales by 1.1% compared to the prior year.
Now, a 1.1% growth rate might sound completely anemic to an outsider.
It does.
But in a 2026 food and beverage environment where discretionary spending is cratering and consumers are trading down to store brands, keeping a premium-priced brand in positive territory is a monumental defense. But the real story requires looking under the hood of that 1.1%.
Because the growth isn't coming from the product that made Quest famous, is it?
No, not at all.
The shining star of this earnings call was Quest chips. Consumption for their savory protein chips exploded by over 17% in the quarter.
Yeah, 17%.
And household penetration for Quest chips is now sitting at an astonishing 11%.
That is a staggering metric for a niche, high-protein, salty snack. I mean, to get into 1 out of every 10 households in America requires crossing the chasm from a specialty fitness product into a mainstream consumer habit. And it highlights a massive structural shift in consumer psychology.
I want to explore that psychology for a second, because for 2 decades, the social contract of the protein snack meant eating something incredibly sweet.
Yeah, always.
It was always a chocolate peanut butter brick or some cloying vanilla shake. It was engineered to mimic a candy bar.
Yeah.
But the human palate suffers from profound sensory fatigue.
Oh, absolutely.
You finish a hard workout or you hit that 3 p.m. office slump, and you don't always want fake chocolate. Sometimes your brain craves salt, crunch, and savory flavors like a tortilla chip. But your diet dictates that you still need the macronutrients.
And that is the exact friction point Quest solved. Extruding protein into a light, crispy chip texture without it tasting like cardboard is a genuine food science achievement.
It really is.
Joe Scalzo noted that Quest Chips is now a $500 million brand in its own right, consistently growing in the mid-teens. Now, he was pragmatic. He openly admitted you cannot grow a $500 million business at 30% in perpetuity.
Right. The law of large numbers eventually catches up to you.
Exactly. They are actively innovating to maintain the momentum, launching things like high-protein cheese crackers to capture even more of that savory snacking occasion.
They also saw a massive surge in the Quest milkshake segment. Milkshakes were up almost 50% in the quarter, but we have to temper that enthusiasm, right?
We do, because it is coming from a very small baseline. When you only sell a small amount of a product, getting it placed in a few hundred new grocery stores will mathematically result in a 50% growth spike.
So it's kind of a vanity metric.
Yeah, it's a vanity metric in the short term. However, it proves a broader thesis. When Quest aligns its branding with exactly what the modern consumer wants, which is ultra-convenient, grab-and-go, drinkable nutrition, they can still effectively recruit new buyers.
Okay, that is the good news. The chips and the shakes are providing cover fire. But now we have to transition to the bad. And this is where the structural integrity of the company is truly threatened. The bad is Quest bars.
Yeah.
The core, the original foundational product of the entire company. Consumption of the core bars fell by roughly 5% in the quarter.
And it is significantly more alarming when you look at the context surrounding that 5% drop. That decline occurred despite a massive volume injection from an incremental club store rotation that began during the quarter.
Okay, let's pull back the curtain on how grocery retail actually works, specifically regarding these club store rotations. We are talking about places like Costco or Sam's Club.
Right.
Getting your product into a Costco is the holy grail for a CPG company because of the sheer velocity of sales. But it doesn't work like a normal grocery shelf, does it?
Not at all. Club stores operate on a treasure hunt model and rotational inventory. You don't just get a permanent spot on the shelf.
Right.
Costco will agree to take pallets of your product for a limited window, say 6 weeks, and place them on the end caps or in high traffic aisles. You have to sell the product in massive multi-packs, and you have to offer it at a severely discounted price per unit.
Wow, okay.
Yeah, the manufacturer takes a major hit to their profit margin on every single bar sold in a club store, but they accept it because the volume of bars moved is astronomical. It flushes cash through the system and boosts top-line revenue numbers.
So to put this in perspective, simply Good Foods secured one of these highly coveted volume-pumping club store rotations for Quest bars this quarter. They flooded the market with multi-packs. And yet the overall consumption of the bar still shrank by 5%.
Exactly. If you remove the artificial steroid injection of that club store volume, the baseline decline of the core Quest bar in everyday grocery and convenience stores would have been deeply terrifying. Joe Scalzo was brutally honest about this. He stated that fixing the bar business is his highest existential priority.
He pointed to two distinct failures on the call. The first was innovation. He frankly admitted that their product development over the last few years has completely missed the mark. They failed to address a very dynamic category.
I mean, look at the protein bar aisle today compared to 5 years ago. It is fiercely competitive.
It's insane.
You have refrigerated bars, plant-based bars, bars with functional mushrooms, bars focusing on gut microbiome health. The consumer evolved rapidly, demanding cleaner labels and softer textures.
And what did Quest do?
Quest, meanwhile, kept churning out slight flavor variations of the exact same dense, chewy protein brick they've made for a decade. They rested on their laurels, and the consumer simply walked away.
And the second failure he pointed to was a complete collapse in marketing strategy, specifically what he called top-of-the-funnel communication. We're going to do a deep dive into that marketing mechanic shortly because it really explains the downfall of almost their entire portfolio.
Yeah, it does.
So before we get to marketing, let's finish exploring the bad side of the ledger with O-Wine.
Right, O-Wine. O-Wine is their premium play in the plant-based, allergen-free nutrition space. On paper, O-Wine actually had a decent quarter, growing net sales by 3.6%.
Wait, if it grew by 3.6%, why are we categorizing it as bad news?
Because of the massive storm clouds gathering just over the horizon, Scalzo used the earnings call to warn investors that O-Wine is facing significant guaranteed distribution losses at major retailers over the next 6 to 12 months.
Let's explain how distribution losses happen, because it really highlights how ruthless supermarket buyers are. A grocery store's shelf is the most expensive real estate in the world.
Absolutely.
Every single inch is calculated for its dollar per square foot return. Scalzo blamed this impending loss on two things: a historical product quality issue that they claim is now fixed, and catastrophic marketplace performance driven by non-core line extensions. What does that actually mean on the ground?
It means the previous management team got greedy. When a brand gets a little bit of traction with a core product like Oian's standard chocolate and vanilla plant shakes, they often try to aggressively expand their footprint by launching wild, niche flavors or entirely new formats.
Like what?
Let's say they launch a seasonal pumpkin spice plant-based cookie or a bizarre fruit-flavored hydration protein water.
Oh, yeah.
They pay massive slotting fees, literal bribes to the retailer to get those new products on the shelf.
But if the consumer doesn't want a plant-based hydration water, the product just sits there collecting dust.
And the retailer tracks every single barcode scam. When a retailer's category manager sees that a brand's new products are dead weight, they don't just pull the dead product. They penalize the entire brand.
They lose trust.
They lose trust in the manufacturer. So when the annual category review comes up, which is when the grocery chain decides what to stock for the next year, they slash OYN's shelf space entirely.
Wow.
Scalzo is essentially admitting that they launched a bunch of garbage products. They didn't put marketing dollars behind them to explain to the consumer why they should buy them. The products failed, and now Walmart and Target are going to evict them from the aisles.
It is a totally self-inflicted wound born of arrogance. But Scalzo claims he is confident in the core 32-gram protein shake powder business, believing the underlying consumer demand for clean, plant-based nutrition remains intact once they clean up the shelf.
Yeah, we'll see.
Okay, we have covered the good and the bad. Now we must address the ugly.
The anchor that is actively dragging this company into the abyss, Atkins.
The numbers for Atkins are genuinely shocking. Net sales plunged 24.6% in a single quarter. Literally a quarter of the entire business evaporated year over year.
And when you look at retail takeaway, which is the scanner data measuring what consumers are actually buying at the cash register rather than what the company is shipping to warehouses, it declined 23.9%. The correlation is absolute. Household penetration for Atkins dropped another 220 basis points and now sits at a dismal 8.5%.
This is the story of a cultural phenomenon losing all relevance. Decades ago, the Atkins diet reshaped the global food pyramid. But Scalzo was remarkably transparent about why this specific corporate asset is dying. He stated it is the direct result of systematic, prolonged, insufficient marketing support.
He described a classic corporate death spiral. Management wanted to boost short-term profit margins, so they cut the advertising budget for Atkins. Because they weren't advertising, they stopped recruiting new consumers.
Right.
Because no new consumers were trying the product, overall household penetration shrank. Because household penetration shrank, sales velocity slowed down.
And then the retailers stepped in.
Exactly. Because sales slowed down, retailers began pulling Atkins products from the shelves to make room for newer, trendier keto brands.
He called it a chicken or egg scenario, but the diagnosis was definitive. Pulling top-of-the-funnel marketing was the single most destructive decision the previous leadership made. The messaging became disjointed, they abandoned their core weight management identity, and the brand was just left to wither on the vine.
Which perfectly sets the stage for Joe Scalzo's grand turnaround thesis. The core of his strategy is acknowledging that Simply Good Foods completely forgot how to build a brand. They became obsessed with financial engineering, and they just ignored consumer psychology. They shifted all their marketing dollars into lower funnel tactics and abandoned the top of the funnel.
We really need to do a masterclass right now on the marketing funnel because understanding this concept is the only way to understand if SMPL can survive. Let's visualize a literal wide-brimmed funnel. The massive opening at the top represents brand awareness. This is mass media. This is a Super Bowl commercial. This is a massive billboard in Times Square. You are spending tens of millions of dollars just to ensure that millions of people know your brand exists, what your core philosophy is, and how you make them feel. You aren't asking them to buy a protein bar right that second. You are planting a psychological seed.
Exactly. Then you move down into the middle of the funnel, which is consideration. The consumer is now aware of you, and they are comparing you to competitors. Finally, you reach the very narrow bottom of the funnel, conversion.
Right, the point of sale.
This is a highly targeted Amazon search ad that pops up when someone types in low-carb snack. This is a brightly colored digital coupon on a grocery store app. This is paying for a cardboard end cap display right next to the checkout aisle.
The bottom of the funnel is designed to close the deal with a consumer who is already in the store, wallet in hand, actively looking to buy a snack. And what Scalzo pointed out is that over the last few years, CPG companies, and Simply Good Foods in particular, became totally addicted to bottom-of-the-funnel marketing. Why?
Because of digital attribution. In the modern era, a chief marketing officer wants to prove to the CEO that their advertising dollars are working instantly.
Right.
If you run a targeted digital coupon on an app, you can track exactly how many people clicked it and exactly how many bars were sold. The return on investment looks spectacular on a spreadsheet.
But top of the funnel marketing, like a funny TV commercial, is notoriously hard to track.
Exactly. You don't know exactly who bought a bar because they saw a commercial 3 weeks ago. So under pressure to show efficiency, management moved all the money away from broad brand building and dumped it into cheap, easily tracked conversion tactics.
But the fatal flaw in that strategy is pipeline exhaustion. If you stop spending money at the top of the funnel to introduce new people to your brand, eventually you run out of people at the bottom of the funnel to convert with a coupon.
You're just preaching to the choir.
Yes, you're just heavily discounting products for the small, shrinking pool of people who already know who you are.
That is the exact trap Quest and Atkins fell into. Scalzo stated definitively that historical data proves top-of-the-funnel marketing investment yields the highest long-term return for this specific company. By shifting away from broad, connected media campaigns, they lost the narrative. Quest was fundamentally built on 2 pillars: craveable taste and superior nutritional profiles. They lost that message.
So the plan is to restart the engine. They have fired their old agencies and hired a new marketing firm for Quest, tasked with a singular objective. Blast the core nutritional and taste benefits to the masses to refill the top of the funnel. They need to make people desire Quest bar before they ever step foot in a grocery store.
But here is the critical friction point of this entire earnings call. Rebuilding a brand through massive, national, top-of-the-funnel marketing campaigns requires one thing above all else.
Massive amounts of cash.
Cash they currently do not have. As we explored with the supply chain inflation, their gross margins are severely compressed. Scalzo outlined that his ideal, healthy profit and loss statement would feature gross margins approaching 40%, allowing him to dedicate a full 10% of total sales strictly to marketing.
But where are they now?
Currently, their margins are in the low 30s. The math simply does not work. There is no money to fund the television commercials that will save the brands.
Here's where it gets really interesting, which brings us to the most controversial, high-stakes moment of the quarter. To generate the cash required to fund the marketing turnaround, simply, Good Foods announced they are implementing a high single-digit price increase across their entire product portfolio, effective in September.
This is the pivot point of SMPL's future.
Let's stop and analyze the pure audacity of this move. You are in the middle of a brutal corporate turnaround. Atkins is in a 24% freefall. Quest bars are shrinking. Your consumers are mathematically proven to be exhausted by inflation, actively trading down to cheaper store brands. Yeah.
And your solution is to jack up the price of your products by nearly 10% right before the holiday season. Won't this absolutely decimate their sales volume? Or are they just going to drive their last remaining loyalists away forever? This brings us to the economic law of price elasticity of demand. And to management's credit, they are not hiding behind optimistic projections. Scalzo flat out admitted to analysts that taking massive price increases is, quote, frankly, not ideal for a turnaround. Understatement of the year. Right. He explicitly warned that they expect the elasticity of the September price hike to be 1 or higher. We have to unpack the exact math of elasticity, because this is how institutional investors model a company's survival. Elasticity measures consumer sensitivity. It calculates how much the quantity demanded drops when the price goes up. Exactly. If a product has an elasticity of exactly 1, it means the reaction is perfectly proportional. If you raise the price of a protein bar by 8%, your sales volume, the actual number of physical bars sold, will drop by exactly 8%. So it's a wash. Right. Your total top-line revenue stays flat, but you are manufacturing and selling fewer items. But if elasticity is higher than let's say it's 1.5, the math becomes highly destructive. If you raise prices by 8%, your sales volume might collapse by 12%. Yeah. The customers flee so fast that the higher price tag can't compensate for the lost volume. You actually lose total revenue by raising prices. And Joe Scalzo is looking the market right in the eye and saying, we expect elasticity to be 1 or higher. He is acknowledging as empirical fact that this September price hike is going to cause a severe, tangible hit to their sales volume. It's going to be ugly. It is going to further damage their household penetration. It is going to make the retail takeaway numbers look horrific in the short term. Then I have to ask the multi-million-dollar question.
If you know with absolute certainty that raising prices is going to drive consumers away and shrink your volume, why do it? Why purposely trigger a volume collapse in the middle of a turnaround?
Because it is a matter of structural mathematical survival. It is short-term devastation for long-term viability. Look at the unit economics of a single protein bar. If inflation in whey protein and packaging has raised the cost to manufacture that bar, but you refuse to raise the retail price, the profit margin on that single unit approaches zero.
Okay, I see.
If you are making zero profit on a bar, it doesn't matter if you sell 100 million of them, you generate no free cash flow. If you have no free cash flow, you cannot fund the top of the funnel marketing needed to fix the brand awareness.
I see the grim logic. They are deliberately accepting a brutal, self-inflicted hit to their volume this fall because they absolutely must repair the unit economics. They need every single bar they do manage to sell to be highly profitable.
Yeah, they need that repaired margin to throw off the cash required to hire the ad agencies, buy the media spots, and eventually win those fleeing consumers back next year.
Precisely. You have to fix the foundation of the P&L before you can paint the walls of the brand. Scalzo noted a terrifying historical trend for the company. Previously, their SG&A, selling, general, and administrative expenses was growing faster than their top-line revenue, while marketing as a percentage of sales was simultaneously dropping.
That is the definition of a bloated, dying company. The executives and the back office are costing more, while the actual investment in the product's future is shrinking.
Exactly. So the turnaround sequence is mandatory. Step 1, address the cost inflation issue with aggressive pricing. Step 2, rebuild the gross margin back toward 40%.
Which gives you the cash.
Right. Step 3, accept the subsequent volume loss and retail pain. Step 4, take the new cash generated by the repaired margins and deploy world-class marketing to restart the growth engine in 2027. Okay, so knowing that this company is bracing for a highly painful, calculated hit to volume starting in September, how does this impact their forward-looking crystal ball? We need to look at exactly what management is promising Wall Street for the remainder of the year.
And just like the Q3 numbers, the forward guidance requires some heavy translation to understand the underlying mechanics. Let's look at the data forward projections for the full fiscal year 2026.
Management guided full-year net sales to land somewhere between $1.345 billion and $1.355 billion. That represents a total annual decline of roughly 6 to 7%.
And on the profitability side, it is even bleaker. FY26 adjusted EBITDA is projected to come in between $220 million and $225 million. That represents a year-over-year decline of about a third.
Wow.
They are projecting a 33% drop in core operational profit for the entire year.
That is a massive valuation haircut for any investor holding the stock.
Yeah.
But when you zoom in strictly on the upcoming Q4, the projections look cataclysmic.
Yeah.
Q4 sales are expected to plummet to between $322 million and $332 million. That is a sharp 10 to 13% decline versus the prior year. And Q4 EBITDA is guided to a measly $52 million to $57 million.
We have to stop and ask a logical question here. If Q3 sales were only down 6.3%, and CFO Chris Bueller explicitly stated that they expect underlying consumer consumption in Q4 to remain relatively similar to Q3, why are the actual net sales for Q4 expected to drop off a cliff by up to 13%?
Right, the consumer is eating the exact same amount of bars. Why is the company making significantly less money?
If we connect this to the bigger picture, this brings us back to that boardroom analogy we started the deep dive with. The answer is a strategy management refers to as under-shipping consumption.
We need to dissect this concept thoroughly because it is a massive, highly risky maneuver in the playbook of retail turnarounds. Let's define the terms. Consumption is what happens at the cash register.
Yeah.
A customer physically buys a box of Quest bars at Target. The barcode is scanned and the product leaves the store. Shipping or net sales is what happens at the Simply Good Foods warehouse. They put a pallet of replacement boxes on a truck, send it to Target, and record the revenue.
Correct.
In a healthy, functioning CPG relationship, shipping perfectly matches consumption. If Target sells 100 boxes this week, Simply Good Foods ships them exactly 100 boxes to replace the inventory.
But under-shipping consumption means intentionally breaking that equilibrium. It means that if Target sells 100 boxes this week, Simply Good Foods is deliberately only going to ship them 85 replacement boxes.
Why on earth would you intentionally starve your retail partners of inventory? By doing that, you are mathematically guaranteeing that your Q4 corporate revenue collapses, which explains the horrific 13% decline guidance. Why take that hit?
To drain the retail swamp. Over the past year, as consumer demand slowed down and the brands lost momentum, retailers ended up with massive amounts of excess inventory sitting in their stockrooms and clogging up their shelves.
Right.
This is especially true for those failing OY and non-core products we discussed and the rapidly shrinking Atkins line.
Right. If a grocery store is sitting on a 6-month supply of Atkins shakes that no one is buying, their capital is trapped.
And more importantly for SMPL, if a retailer is choking on your old, stagnant inventory, they are furious with you. They will refuse to buy any of your new, innovative products. They will strip away your premium, eye-level shelf space. You become a liability to their profit margins.
So by intentionally undershipping the actual rate of consumer purchases, management is forcing the retailers to rely on their backroom stock. They are forcing the grocery chains to burn through their existing excess inventory to fill the shelves.
Exactly. They are taking a massive financial punch to the gut in Q4 net sales, specifically to ensure that the retail pipeline is completely drained and correctly sized heading into fiscal 2027. It is a necessary purge. Once the excess inventory is gone, the relationship with the retailer resets. When a consumer buys a box in Q1 of 2027, the retailer will have no choice but to immediately order a new box from the company to replace it, bringing shipping and consumption back into a healthy alignment.
It is the corporate equivalent of undergoing a brutal fasting protocol to clear toxins out of your system before starting a new nutritional regimen. You feel incredibly weak in the moment, your metrics look terrible, but it fundamentally resets your metabolic baseline.
And this highly defensive cash preservation posture is echoed across their entire capital allocation strategy. CFO Bueller noted that they are drastically pulling back on capital expenditures, or CapEx.
CapEx is the money a company spends on big, physical, long-term assets. Upgrading manufacturing equipment, building new warehouses, integrating new software systems.
Right. They reduced their projected CapEx for the year down to the $25 to $30 million range, significantly lower than previous expectations. Now, they're still funding the previously committed capacity expansions for the fast-growing salty snacks business because you always feed your winners, but everywhere else, they have instituted a freeze. They are scrutinizing every single dollar that attempts to leave the building.
Because in the middle of a turnaround, cash is your oxygen supply.
Yeah.
You have no idea how long you will be held underwater by macroeconomic forces, so you hoard every breath.
Precisely. And looking at their balance sheet, they have some breathing room. They're sitting on $123.9 million in cash. They have a $400 million term loan, but their net debt to trailing 12-month adjusted EBITDA ratio is a relatively healthy 1.2 times.
That ratio is crucial. It means they aren't drowning in leverage. The banks aren't going to call in the loans tomorrow and force a bankruptcy.
They also spent $240 million buying back their own stock over the past 12 months, which artificially supports the share price, and they still have $158 million remaining on their authorization. But right now, the primary use of all free cash is funding the turnaround mechanism itself. They are prioritizing structural repair, fixing the gross margin, and draining the retail inventory over chasing short-term vanity metrics to please impatient analysts.
Okay, so we have laid out the entire anatomy of the Simply Good Foods operating theater. We've seen the pricing hikes designed to offset commodity inflation. We've explored the massive pivot from digital coupons back to top-of-the-funnel brand building. We understand the painful necessity of undershipping inventory to clear the retail channels.
Yeah.
So what does this all mean? Taking all of this financial remodeling into account, what is the ultimate verdict for the retail investor?
If you are looking for an honest, actionable stance on SMPL right now, the verdict has to be split based on your time horizon.
In the short term, the outlook is profoundly bearish. If you currently hold the stock, you need to mentally prepare for a highly volatile, ugly 6 to 12 months. The September price hikes are a necessary medicine to save the margins. But as we discussed with the elasticity math, it is absolutely going to damage their sales volume.
The consumer is going to feel the 10% price hike at the register. In an environment where grocery budgets are stretched to the breaking point, a significant portion of buyers will simply trade down to a private label protein bar or abandon the category entirely. The retail takeaway data is going to look bleak.
And on top of that volume shock, the structural reset of the Atkins brand is going to take immense time. You do not reverse years of marketing neglect and a 24% collapse in a single quarter.
No, you don't.
Furthermore, the OWYN distribution losses that Scalzo warned about haven't even fully materialized on the income statement yet. The next few earnings reports could feature horrific top-line revenue numbers as these fixes slowly work their way through the retail system.
However, if you have the stomach to look past the immediate wreckage and focus on a multi-year horizon, there is a compelling case for a cautiously bullish view. For the patient investor, this is setting up to be a classic value play.
I want you to build the bull case thesis right now, and I will try to poke holes in it. Why should an investor risk capital on a shrinking company?
The bull case rests entirely on the pedigree and execution of Joe Scalzo's turnaround playbook. He has correctly diagnosed the disease. The previous management chased cheap digital distribution at the expense of consumer demand, they let margins decay, and they forgot how to build emotional connections with buyers. His prescribed treatments are textbook.
So the thesis is, if he can successfully raise prices this fall to offset the protein inflation and then use that repaired gross margin to fund world-class top-of-the-funnel marketing, the brands have enough historical equity to bounce back.
Yes. Remember, he brought back the exact advertising agency that orchestrated the massively successful Rob Lowe campaign for Atkins years ago. They know how to build relevance. Quest is still a structural powerhouse. Their salty chips are growing at 17%. And fundamentally, the broader macroeconomic tailwinds for health, wellness, and convenient nutrition aren't disappearing.
That's true.
The purposeful nutrition category as a whole still grew 10% in this time frame. People want high-protein, low-sugar options.
But the risk is execution. The strategy is sound on paper, but raising prices while cutting retail inventory is akin to juggling chainsaws on a tightrope. So what is the actionable advice for the listener?
Simply Good Foods is currently the ultimate show-me story. If you're sitting on the sidelines, stay there. Do not try to catch the falling knife until management actually proves they can execute the physics of this turnaround.
What are the specific, measurable leading indicators an investor should demand to see on future earnings calls before committing capital?
Joe Scalzo actually gave us the exact roadmap to track his progress. He warned analysts not to anchor on a specific timeline or wait for a single quarter where suddenly all the metrics turn green. Turnarounds happen in distinct stages.
Okay.
Indicator number 1, you must watch the gross margin. You need to see the margins actually stabilize and begin to expand back toward that 40% goal. That will prove the September price hikes worked without triggering a total collapse in consumer volume.
Show me the margin recovery first. If the margins stay compressed in the low 30s despite the price hikes, the turnaround has fundamentally failed. What is the second indicator?
Indicator number 2. You need to see the new top-of-the-funnel marketing campaigns successfully restart consumption growth in the core Quest bars, and at the very least, stabilize the bleeding household penetration for Atkins. Once you see the brand awareness metrics stop plunging and start flatlining or ticking up, you know the marketing is resonating.
Makes sense.
The overall financial results will eventually follow those leading indicators, but they have to show you the proof of concept in the margins and the marketing first.
And there is one final, overarching wild card hanging over this entire corporate narrative, particularly for the Atkins brand. It's a topic that dominated the analyst Q&A session at the end of the call, and it represents perhaps the largest shift in food consumption history.
Oh, yeah. The explosion of GLP-1 weight loss therapies, drugs like Ozempic, Wegovy, and Mounjaro.
This is where the deep dive transcends corporate finance and touches on human biology. Management noted that they just completed a massive proprietary assessment of GLP-1 users to understand how these drugs are permanently altering consumption behaviors.
And the findings present a massive paradox for Simply Good Foods. Scalzo revealed that there is already a surprisingly high rate of interactivity between consumers who purchase Atkins products and consumers who are actively using GLP-1 therapies for weight management.
Which theoretically proves the Atkins brand is still highly relevant to that specific demographic. But the strategic question is incredibly complex. How do you actually market a food product to a demographic whose defining characteristic is that a pharmaceutical intervention has chemically eradicated their desire to eat?
That is the multi-billion-dollar puzzle. Previous management teams looked at the GLP-1 trend and assumed the play was to market to people transitioning off the drugs.
Right.
The logic was, once you stop taking Ozempic, your hunger returns, and you need a high-protein, low-carb diet to prevent the weight from rebounding.
But Scalzo seems to have rejected that premise entirely. He is looking for a deeper insight to market to these patients while they are actively on the medication journey.
Exactly. Think about the pharmacology of GLP-1s. They mimic a hormone that signals extreme satiety to the brain, and they significantly delay gastric emptying. People on these drugs simply cannot consume large volumes of food.
Yeah, they just get too full.
But a major clinical side effect of rapid weight loss on GLP-1s is sarcopenia, the dangerous loss of lean muscle mass. Because patients aren't eating enough total calories, they aren't getting enough protein to maintain their musculature.
So the theoretical pivot for a brand like Atkins or Quest isn't just weight loss. It is muscle preservation. The marketing message evolves too. You only have the physical capacity to eat 1,000 calories today because of your medication. Every single bite must be engineered for maximum protein density to save your muscle mass. Eat our concentrated protein bar.
Scalzo was incredibly tight-lipped about the exact strategy. He essentially told the analyst to be patient, confirming that the new marketing agency is dissecting these exact insights right now. They hope to test some new messaging frameworks in the marketplace next fiscal year, but they have to prove they can crack that psychological code. And more importantly, they have to prove that the unit economics of acquiring a GLP-1 customer actually yields a positive return on investment.
It is the ultimate existential crossroad. Which brings us to the final thought for this deep dive. Something for you, the listener, to mull over as you watch the entire consumer packaged goods sector navigate this unprecedented era. We have spent this time dissecting the mechanics of the SMPL turnaround, the inflation supply chains, the pricing elasticity models, the draining of retail inventory. But let's zoom out to the broader societal level.
The Ozempic economy.
Exactly. As GLP-1 therapies become cheaper, move to oral pill formats, and fundamentally reshape the American appetite by naturally suppressing hunger at a chemical level, we have to ask a profound question about the future of food.
Yeah.
Will traditional diet and weight management brands like Atkins successfully pivot to become vital nutritional companions to these therapies, providing hyperdense protein for people struggling to eat enough? Or will these legacy brands eventually be rendered completely obsolete by a new era of consumers who simply eat less of everything, regardless of how many net carbs, sugars, or protein grams are printed on the shiny plastic wrapper?
It is a fundamental paradigm shift in human consumption. Simply Good Foods is standing dead center in the impact zone. Over the next 2 years, they will either learn to surf that pharmacological wave, or they'll be entirely crushed by it.
It is going to be a fascinating, volatile dynamic to watch unfold on the grocery shelves and on the stock tickers. Thank you for joining us on this deep dive into Simply Good Foods. We've sliced through the corporate jargon and laid bare the brutal, fascinating anatomy of a modern retail turnaround.
And remember, whether we are talking about repairing a broken brand identity or fixing a shattered balance sheet, the mechanics of recovery require immense time. In a corporate turnaround story, strategic patience is just as critical as the quarterly numbers.
Keep your eyes on the tickers and your mind on the big picture.